This is TreppWire Week in Review for week ending January 7th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, the virus case surge has topped previous records, and post-holiday air travel resumed normal levels. And the CDC recommends boosters for 12 to 15-year-olds. In economic data, manufacturing and services activity slowed last month. Private sector employment boomed in December, and jobless claims stayed near pre-pandemic lows. The Fed minutes released this week signaled that officials are ready to raise rates sooner than anticipated, and Manus, the markets reacted.
Thanks, Martha. Let me say that just as a factoid behind the TreppWire podcast, we normally record at 4:30 on Thursday afternoons. Today, we're recording at 1 p.m. on Thursday afternoon. As I was watching the Fed minutes and the reaction to it, I couldn't help but think about the old Southside Johnny and the Asbury Juke song, "This Time It's For Real." And by the way, that's one of the most underrated bands to come out of New Jersey, in my opinion. So that song came out in 1989, and it just reminded me this week that about every 6 to 8 weeks, we have one of these scares that pushes the rate on the 10-year Treasury up 30 or 40 or 50 basis points. People rush for the exits like they're Will Ferrell in Elf going through the revolving door. And, everybody starts talking about how the 10-year is going to be 2%, 2.5%. Here it is, once and for all. And over the last week, we have seen the 10-year go from about 1.5% to about 1.75%. to now at its highest level since last April. But every time we've had one of these false starts where we see a stock market sell off and rates, take up, 2 weeks later, we're back to a 1.5% Treasury, a 1.4% Treasury, and the markets are rallying anew. At some point, this will be real. And maybe this time, it will follow the Southside Johnny lyrics. But I can't get over the fact that it just keeps feeling like false start after false start.
So I think what some of the news folks that I've been reading, and then I was looking at the minutes themselves, the interesting piece of the minutes, it seems that people are glomming onto, is that the board members were talking about actually changing the timing of the balance sheet runoff and the balance sheet reduction. They're very, very vague, right? But in some ways they're saying what we could do is raise rates a few fewer times, if that makes sense, as opposed to in the past, they've raised rates, quarter, then next quarter, then next quarter, and they do that for a certain amount of time, and then they start running off the balance sheet. I think what they were saying here is that maybe a way to do this is actually to do both at the same time or very close to each other, but not have to raise rates as many times or get to such a high level. So I think that the market was a little bit spooked by, once the runoff in the balance sheet starts happening, essentially, for a simple macroeconomic, for a simple macroeconomist like myself, try to get that out of your mouth. The point is, once they start selling treasuries or letting the treasuries or the mortgage-backed securities mature and they get cash into their balance sheet, that cash is no longer in circulation in the market, right? So that's why you saw things like Bitcoin and Ethereum and all that other stuff just get absolutely hammered the last couple of days, because a lot of that stuff, has rallied on the fact that there is just double or triple the amount of cash in the system as there was before the Fed started increasing their balance sheet.
Well, I think you're spot on, Joe. I think that the shock to the system was the shrinking of the balance sheet comment, for sure. And to expand on your point, if you are kind of changing the direction of the flow, from taking large chunks of securities out of the system, not only are we not taking them out of the system anymore, which was what tapering was, now we're saying, let's put them back into the system. That increases supply, which theoretically should push up rates, probably more heavily tilted towards the long end, I would think, the 10 and the 30 year, which I think is what the Fed wants. I think that they think that this, 1.5% 10-year treasury is kind of unhealthy. Kind of putting words in their mouth, but that's kind of the sense I get. And so that's where we're going. But my own opinion is that I do believe that the US economy is strong enough to take this on. And I do think that this is not going to be like the bucket challenge, right? Where they dump all this stuff over us and, they flood the system, they flood the zone. The Fed, if nothing else, has been incredibly measured, and they're going to watch us very carefully. And I think it's going to be very incremental.
So they did also mention in the minutes the idea of the yield curve and how in previous rate raising scenarios, they've driven the federal funds rate up, which drives short-term rates up, but they didn't see an equivalent increase in the long-term rate. So the yield curve was flattening, which is not good for financial intermediaries, AKA banks and other lenders. So that was mentioned there. So it kind of makes sense if you can kind of drive up the interest rate on the long end, not to a crazy extent, but slowly, and you can drive up the short end. That's not a bad thing. I just want to say, Manus, you mentioned the ice bucket challenge. I'm pretty sure the shirt you're wearing right now was the shirt you were wearing when you were on the balcony of 477 Madison when we dumped ice water on your head. Probably, what was that, like 5-6 years ago now?
Yeah.
That was a great example of, one largely anonymous human being turning the tides and creating something really good out of something really bad, right? That one guy had ALS and really started this movement, which was just quite wonderful. So love stories like that. It was worth getting doused by you and Keegan.
I think Sarah was in there too. I don't know if she still listens.
I think we videotaped it.
I doubt it.
We videotaped it. We could actually share it with
we
people.
should actually share that. It's probably in the annals of our Facebook or Twitter or something. I will just say one more thing about the minutes, and then we can move on. Another piece that I caught, because I didn't see anywhere else in the news stories, but it's kind of relevant to our world. Participants also discussed the composition of the Fed's asset holdings, consistent with previous normalization principles. Some participants expressed a preference for the Fed to hold treasuries, basically. So what they're saying is some participants favored reinvesting principles from MBS, mortgage-backed securities, into treasuries. So that's a little interesting. It would continue to support the treasury market, but maybe lead to a little widening in the MBS market. Like it wouldn't be kind of equal for equal there.
Yeah, I mean, setting aside the panic that the market had in panic is never a good thing. The longer term prospects, as long as you don't blow up the long end, right? As long as this is a modest steepening, and as long as the US economy can kind of absorb this, what this does is perhaps, as we turn this back to the commercial real estate and the real estate market in general, it may take just a little bit of the air out of the asset inflation we've seen on the housing side for the last year or two, right? People borrowing at 2.5% to get an $800,000 house. Well, maybe if mortgage rates go back up to 3.5%, right, we see a leveling off of demand, and that allows first-time home buyers in the door, right? And we see some of this mania that defined so much of the spring and summer of 2021 not come back. And that would be a good thing as long as we're talking about rates in the mid threes, not in the mid fives.
Right. Well, here's your classic economy versus markets question, right? So the economy, I agree with you, Manus, is strong enough to handle slightly higher rates, but a company, a slick SaaS VC funded tech company that's priced at 1,000 times revenue, those are the ones that get really hurt in these scenarios. And that's what you've seen this week. You've seen all the big growth tech type names, getting hurt.
Which doesn't make a lot of sense because these guys are not borrowing in the fixed income market. It's not like their borrowing costs went up. They're borrowing in the equity markets, right? So the shock to the system is people may say, well, I don't want to fund this anymore. I want to put my money into something that's fixed income. I don't want to put into something which is, a potential unicorn. I'm not a big buyer of that I think it's two
Yeah.
different markets.
Yeah.
You know, people may go from the S&P 500 and its 1.5% dividend yield to, you know, a fixed income bond fund, but I don't think that startup gets crushed. So kind of this racing for the exits in the tech world, it doesn't make a lot of sense to me. But you know, then again, I'm not Jeff Bezos.
Well, Manus, all of the investment bank and equity coverage analysts that are updating their super fancy DCF models and increasing the discount rate by 50 basis points would disagree with you. But I agree with what you're saying, right? Because those DCF models don't really make a lot of sense for these companies that are really, you know, you can't really predict the next 5 years of these super high growth companies,
right,
with any sort of accuracy. So I'll agree there. Well, I will say maybe we're getting to the point where it's no longer Tina, it's now Tia. There is an alternative, right? Whereas before everyone was investing in equities because there is no alternative. So I don't know. We're getting ahead of ourselves here and talking way too much about the Fed. So Martha wants us to talk about real estate now, I think.
Well, we do have the delinquency report that we released this week, and we've seen an increase for the first time in 18 months. So I do think it's something worth talking about.
I think maybe the markets were reacting to the delinquency report and not the minutes.
There you go. So we can, you know, tune our own horn just a bit. We held our podcast for our 2022 predictions late last year. I think we taped it around December 20th, give or take. And what we said was, or one of the predictions we made was that 2022 would see an uptick in office delinquencies. I think we said that it wasn't going to be catastrophic, it'd be more episodic. But these types of properties that are B and C listers, you know, kind of older properties, a little bit dated, not ESG certified, not LEED certified, that had big tenants leaving, particularly in cities that had seen a lot of new development over the last couple of years, could start seeing some of these hiccups. And we saw a couple of those last month, which led to a spike in the office delinquency rate. We highlighted three or four, I should say, in the delinquency report that really caused the office delinquency rate to uptick. Two were properties that are affiliated with HNA, the HNA Group, the big Chinese company that has had some liquidity issues and had one of its affiliates file for bankruptcy. It's 245 Park Avenue loan, and it's 181 West Madison Street in Chicago loan. Those loans total more than 1.2 billion. Both went 30 days delinquent in December. So that was kind of bankruptcy related. The other two that we highlighted, one was 175 West Jackson in Chicago, which has been kind of limping along for a long time. Its DSCR has been under 1.0x for several years. So it kind of seems like the borrowers are kind of reaching perhaps the point of exhaustion in supporting this thing. And the other was a story we've talked about in the past, 135 South LaSalle, which has lost Bank of America and 600,000 square feet there recently. And that loan went 30 days delinquent. So an uptick of, I think, 75 basis points this month, which led to a 19 basis point uptick in the overall delinquency between November and December.
So I just want to say that Haley, this is worth mentioning, Haley sent around the link while we were discussing it to that video of Manus doing the ice bucket challenge. And I must be 100 pounds heavier since that, because holy moly, how long ago was that? That's a little scary to see that that's what I used to look like. Anyway, Manus, you haven't aged a day.
The other parts of the delinquency report were pretty promising. So even though the headline number went up, we saw improvements again for hotels. The special servicing percentage for hotel loans came down 132 basis points. It's now under 14%. For retail loans, another 32 basis point improvement in the special servicing category. When we look at delinquencies themselves, lodging came down 61 basis points. It's now under 9%. Retail came down 19 basis points. It's now in the low eights. If you recall, June of 2020, lodging was close to 25%. Retail was 18 or 19%. So those parts of the market continue to heal. And that's the takeaway I think our listeners should focus on rather than the uptick in office.
we've mentioned this before, at least for me anyway, there's some sort of psychological barrier or I don't know, a tipping point or whatever you want to call it, where once you get below 5% on the delinquency rate, and I always compare it to the unemployment rate, I feel like once you get below 5%, you start to feel like, okay, we're okay now. You know what I mean? You want it to be lower, but if it had come down to 7% and stopped and plateaued at 7%, you'd still feel like there was some real distress out there. But the below 5% feels like a good place to be. I think that we could have cheated, although maybe Manus, you cheated and looked at the data when we did the predictions a couple of weeks ago, but we didn't. I'd be interested to see what this office number, if this continues to kind of blip up and down, but kind of in a slow upward trajectory over the next year or two. That's kind of what our prediction was.
Yeah, if we're going to point to another loan out there that I would keep my eye on, we talked about this in July in our TreppWire research, our daily research. We wrote about it again in late December, and this would be 300 North LaSalle in Chicago. And we'll give this one away as a freebie. So if you're listening and you want a copy of this trading alert, let us know and we'll share it with you. Back in July, we noticed that Kirkland and Ellis was planning to take 600,000 square feet at a new Chicago development. Those talks eventually turned into a big lease at an under construction property. K&E has 51% of the space at 300 North LaSalle. That particular property backs $450 million in CMBS debt. The senior loan is probably fine. It's a 27 LTV asset, so incredibly under-levered, but there is $244 million in B note out there. Why did this get our attention again in December? It's because Crane's Chicago was reporting that the Boston Consulting Group was close to moving out of the same building. They're going to take 200,000 square feet in the Fulton Market. They're the second largest tenant at 300 North LaSalle, 11% of the space. None of this is imminent. Kirkland and Ellis can terminate their lease in 2025. BCG goes out, I think, until 2024, but 62% of that square footage in that property is going to be, empty at some point in the future. So keep an eye on that one.
Sticking with office, we have a lot of office stories. We probably will only get to a fraction of them, but many companies have backtracked already on their return to office plans, which is something we all predicted. And that's having an effect on office supply.
It is, but I think that there have been more green shoots than crabgrass over the last couple of weeks, particularly in New York. There were a couple of stories there that I loved seeing. So I'll start with those and we'll get into some of the crabgrass after that. Morgan Stanley, this is a Bloomberg report, announced that they were going to take 400,000 square feet on 52nd Street. The space where they're going is currently occupied by BlackRock. BlackRock is moving to Hudson Yards. The fact that BlackRock was moving meant that there was going to be a huge hole in 2023 at this CMBS loan that has sizable debt on it, a couple of $100 million, $450 million. So this is the closest thing I would say that we've seen to pro forma lending since the great financial crisis, like real pro forma lending. This particular owner got a $450 million CMBS loan, knowing that BlackRock was leaving in 2023, that there would be a big hole there, and lenders took a leap of faith and lent on this. And this week, Bloomberg reported that Morgan Stanley is going to backfill all of the BlackRock space. Tremendous green shoot, good for Morgan Stanley, vote of confidence for the New York City market. So that's my first story there. That was right around the corner from us too, and it was it's a nice building. The other one was the New York Post. Steve Cuozzo reported on Monday that the Rudin family had signed Touro College and the university system for almost 250,000 square feet at 3 Times Square. If I'm not mistaken, that's the building that drops the ball every year. It has the big ball in Times Square that is lowered on New Year's Eve. The big story there was that Reuters was planning to leave. Rudin now has backfilled them with 250,000 square feet. Again, wonderful. We wrote about this a while back saying it may result in fewer wingtips at 3 Times Square and more Nike or Adidas sneakers coming and going. But, the Times Square market is not loved. It hasn't found those big, they got TikTok, yes, but it's never gotten in like an Amazon or a Google or a Facebook. So in my world, 250 from any tenant in that market is a big win. So good for New York for these big numbers.
And it's just to let you know, the kids these days are wearing white Filas, which is actually a complete throwback to the 80s, which just blows my mind. Let me ask you quickly, back to the old BlackRock building, or the current BlackRock building's eventually going to be the old BlackRock building. So the deal was done in 2021, meaning the new loan was done in 2021. And then just this past week, we saw the Morgan Stanley news, right?
We did. There was a footnote in the loan when it was made addressing the fact that only, I think, 10% of the BlackRock space had been accounted for after 2023.
Right.
And I think it was, I can't remember off the top of my head, but it was footnoted that 90% of the BlackRock space was looming. Right. So that, good for the underwriters for revealing this and making this a footnote in the deal. But it is, like I said, the closest we've seen to kind of a pro forma situation of that kind of size.
Yeah, I wonder, I'm just thinking that if the Morgan Stanley deal was kind of in the works, but it wasn't inked or clear yet, and that's what gave the underwriters comfort. Maybe. We can't tell, but
it could have been. I mean, the rumors could have been out there, but if you start trafficking in rumors with a securitization doc, that's the kind of thing that gets you in trouble. You got to really deal with the facts, and their legal teams did.
So I have to mention on the office side, I never ever tweet, almost never. I'm very scared to put anything in writing on the internet. I'll put anything in audio on the internet for some reason. But our friend Dogged Tenacity was tweeting at us this past week, posting up I think it was a Bloomberg article about 30% of U.S. workers back to the office. We talked about this in our predictions as well. And he said, let's see if the new year changes this. And I told him what we said on the pod, which was, I don't think we get to 60% in 2022 in New York, Chicago, San Francisco, et cetera. And then someone else came through and mentioned something to me, basically saying, this is CAI guy. More interesting to me is Texas and other fully open states or areas that have only 50 to 60% people in the office. And then it was kind of, the idea was maybe that 60% is the new 100%. You know what I mean? So you may be fully leased, but you're only 60% of the people from those companies are showing up to your office on any particular day. That might be our new hybrid work from home, what someone on Twitter called it endemic stabilization, physical occupancy.
That feels right to me. That 60% number, I think the muscle memory of what is now 22 months of pandemic, people getting used to working from home, enjoying it, enjoying that flexibility. I think that, I'm no, seer of the future, but that feels like a number that's right.
Well, Manish, what's 3 out of 5?
There you go, 60%.
60%. So if generally everyone's doing this hybrid 3 in, 2 out, there's your 60%. So nothing like a good back of the envelope prediction there.
I was looking for the word. I'm no medium. Right? I'm not seeing the future.
Island. You could be the next Long Island medium.
There we go. So I promised some crabgrass, and I'll give a few more green shoots after that. I'm bringing in the crabgrass now just to talk about what Joe was saying about the new normal and who's going back. A gentleman named Wolf Richter writes Wolf Street on the internet. You can find it at wolfstreet.com. And he put out a piece recently that talks about the latest release of Castle Systems data. Castle Systems is one of the firms that tracks people coming and going in offices. They have a 10-city average. It's sobering. The Wolf Street numbers, the graph that they have show the percentages of people in the 10-city average that, between June of 2020 and November of 2021 has only gone up from 20% physical occupancy to what looks to be about 40% on the graph. And every 2 or 3 months, every time we see a new Greek letter of the Delta variant emerge or the COVID-19 variant come out, you see big dips So I would point our readers to that. I don't want to give all of it away. It's Castle Systems data, and it's the Wall Street story. But they talk about Houston, which you would think would be a pretty good market, right? It's in Texas, which is generally tried to stay open. It's a warm weather area, still at only 30, low 30s, and that's kind of scary. So look for that if crabgrass is your thing. I'll go through one or two more green shoots. Some good news coming out of Raleigh. We saw 2 sales there with really sizable price appreciation in the last couple of years. Both were sold to a guy named Dean Debnam. One was Briar Creek Corporate Center, sold for $306 per square foot. That represented 56% price appreciation since 2009. The properties on Glenwood Avenue, Class A, 100,000 square feet. Another one is, this was not Dean Debnam, this is City Office REIT, bought Block 83, a 2-building Class A property, almost 500,000 square feet. In this particular case, $670 a square foot. So the properties were built between 2019 and 2021. And in the case of the second one, it's still in lease up. So 2 really good comps there for the Raleigh office.
Turning to retail, we saw some store closing announcements, not unusual at the beginning of the year.
Yes, December is the season for giving, or the month for giving, and January is the month for store closings, right? And it makes sense. Why close in December when you could squeeze out one more holiday season? If you're planning to close a store, it's a good time to get rid of inventory before you have your going out of business sales, right? It's a month where you can squeeze maybe one more profitable month out of a store that you don't love. The 2 big names we saw yesterday were Macy's closing 7 or 8 stores. It's kind of more of a green shoot than a crabgrass story, because at one point they were planning to close a lot more stores than that. They reduced the number because they thought they were starting to see the light at the end of the tunnel. So 7 or 8, I think 7 were Macy's names. 1 was a Bloomingdale's. Only 1 touched CMBS. The most interesting one for me, and this was not a CMBS story, but they're closing one in Lee's Summit, Missouri, which is the Kansas City market. That store's only been open for 10 years, so that's throwing in the towel fairly quickly on that one. So that was one. The other was Bed Bath & Beyond, which announced it was closing 37 stores. There, about a quarter of them touched CMBS loans. Often BB&B is the second or third largest tenant with 10 to 20% of the square footage. So we put that out as a trading alert today. BB&B's stock got hit today when they announced that they were still struggling with big time supply chain issues. So those were 2 stores we were focusing on this week. Another couple of other store closings. We saw Old Navy had a one-off in Boone, Kentucky. Williams Sonoma was closing 2 stores in New York Mall. So drips and drabs. We had said 6 months ago, we had made a call that the era of the big store closing announcements was over, and we stand by that, or at least I do, where you used to see 2 or 3 or 400 stores closing from JCPenney or Macy's or somebody else, other than the drugstores, which have been closing stores kind of rapidly over the last 6 months. If you've held on through COVID and you're a Dillard's or a JCPenney or a Macy's, chances are you'll like that store and you're going to fight for it. And so I don't think we're going to see these enormous waves of store closings for the next 5 years like we saw from 15 to 19.
I mean, yeah, even if you just did the math, how many retailers have enough stores open that they could announce 50 or 70 or 100, right? And if you did find then those retailers, most of them that still have hundreds and hundreds of stores are the ones that have kind of survived through this whole thing and are doing okay. So that the numerator or the denominator or something is a lot smaller than it used to be.
We will talk about one other retail story, which I would call a green shoot with perhaps some caveats. the Westland Mall in Hialeah, near Miami, was sold by Starwood. The buyer will assume a $149 million mortgage. The buyer was Centennial Westland Partners. And if you use the 149 million as a proxy for value, you're talking about $495 a square foot. And I think that's a great green shoot. We went to our man who really knows these markets. He's been on our podcast before, Darren King, to talk about this. And he gave us some insights. He called it an everyman generic mall. So this is not a type of thing like the Mall of America where there's all kinds of entertainment and food and destination venues that people go to. This is your meat and potatoes, JCPenney, Macy's with a dark Sears. So this is a great green shoot for me that somebody's willing to pay 9 figures for this. He pointed out a couple of other things in there. Number one is that this particular area is a great area, right? Miami, it's attracting more and more people all the time. But he also said, sometimes with loan assumptions, you don't get the whole picture, right? There's other accommodations in there. It's kind of like a player getting traded in Major League Baseball, but the trading team picks up some of the contract that's still due on that player, right? Sometimes there's other accommodations that are made that you don't know about. But $500 a square foot, if we can count on that as a number, wonderful.
Yeah, so it's an interesting story just kind of thematically because we know Starwood has really significantly reduced the number of retail properties on their books, right? I think it was in the 100 plus range, and I think they're down to like around 20 or something like that. These are just kind of anecdotal numbers I've been skimming. But Barry Sternlicht and Starwood are really smart institutional investors, so not too surprising or controversial that they're reducing their exposure to malls, but just interesting to see it keep happening.
I've disclosed in the past that I was a buyer of Starwood sometime between 6 and 12 months ago, and I've actually added to that position in the last month or so. I just believe in them and their machine and their conveyor belt, and I'm with you, Joe. I think that they are smart people and they pay a big fat dividend, which I like. You want to talk about the CVS, Joe, in South Beach? You're a movie guy.
Say hello to my little friend. Yeah. So did we put this in TreppWire, or was this
This was not in TreppWire.
No, this was just something that we were kind of bandying about via email. So the CVS at 728 Ocean Drive was sold for $3,066 a square foot. And why do we care? Well, if you saw a picture of the property, you would probably recognize it. It's that white kind of office, 3, 4, 5-story kind of office building looking building that was used to film a 1983 film called Scarface.
Right,
so
say hello to my
definitely,
little friend.
I don't know if you call it a green shoot or a green shoot 'em up, or I don't know. What else you got?
It's funny because I chat with Steve Cuozzo of the New York Post from time to time, and I'm not sure why this came up. I guess we had both been at South Beach around the same time, maybe a couple of years ago, and he said that CVS is like such a scene. It's 24 hours, and because basically Miami Beach never sleeps. That thing, there's 100 people in that CVS, even at 5 o'clock in the morning, right? Either getting hangover cures or, I guess maybe they could buy cheap alcohol still at the CVS. I don't know, at 5 o'clock in the morning. But he described it as one hell of a scene. So that's a good segue for us, Miami Beach. A couple of us will be in Miami Beach at the Lowe's next week, Monday and Tuesday. And it's part of an industry conference. CREFC will be down there, and we will have a cabana. Originally, I think that they were hoping for a couple thousand people. It may be less because of the Omicron, but we're going to go there and hoist the Trepp flag. So if you're either going to the conference and want to come by and have a mojito with Haley or Martha or I, please do. You can get some Trepp swag. If you're in the Miami area and you're not going to the conference, but you want to come over and meet us for a a cocktail and talk about anything and everything in the CRE market, or anything beyond that, even the Allman Brothers or NFL football. We're up for anything.
The Allman Brothers or NFL football, but nothing else.
Nothing
please.
else. That's it.
This
That's
is
the extent of us.
I got a ping from a guy named John, who I've never met, but he's going to be down there, and we're going to meet up. And his email to me was, let's talk about the Allman Brothers when I'm down there. So I'm looking forward to that. And I may be talking a little bit out of school here, and I hope that if I am, John Devaney will forgive me for bringing up his name. He's a trader. He's been around for a long time. He makes markets in kind of AA and lower CMBS bonds, the kind of stuff that trades in the 40s to 80s range. He's down there. And while many of the big banks have canceled parties down there, he's still going forward with his. So this is not my party. So I hope I didn't get an angry call from John for touting the fact that he's hoisting his own flag. He's going to have some live entertainment there. So if you know John and you're in the area, maybe you can wriggle out an invitation from him. He's deeply involved in the CMBS market, and he'll be forging ahead with his party.
And in concert with the conference, we typically publish the year end with our sister company, CRE Direct News. It is chock full of data. So if you want a copy of that, give us a shout. We'll be happy to send it to you free. We distribute it at the conference, and we also send it out to people who are interested in the industry. So ping us and we'll send it to you. We have a couple shout outs. Brian B., who's a regular listener and asked for a copy of Lonnie's report on Class B and C office buildings. He compared the retail market to the office market and some similarities there. He also said our team sounds like the nicest set of people ever. And I'd have to say that's probably true for 3 out of the 4 of us. You'll have to think about who that one is that maybe isn't the nicest. But thank you for saying that.
It's like that Sesame Street thing that you'd watch with your kids. Which one of these things doesn't belong?
Exactly.
You can feel free to throw in your vote and let us know who you think that outlier would be. It might be interesting to us. Maybe
Who
a
they
little
think
bit.
it is.
It could be a little humbling and sobering if it turns out to be me.
I don't think so.
But I think my
so,
family would probably vote a lot of times for me.
We're just here to fill the air around you. That's all.
And then on Twitter, we had a couple of shout outs. Arpit G on office loan delinquencies ticking up. Our Chris W also on the same topic. And, you know, I noted that, and we're back at home, which obviously has its own challenges, but according to Procter & Gamble, 74% of Americans are concerned about how their homes smell. And I'm guessing since they sell Tide detergent and things like Febreze, they've got the solution for that. But apparently domestic odors have been worsened by most of us staying at home. Either we're not bathing enough, or we're exercising at home, or we're not changing our clothes. I'm not really sure what the cause is, but concerning.
I think it's just kind of sad. We care more about what the people we work with think about us and what the people on the commuter railroad think about us than what our family thinks about that. Maybe it's just, a positive comfort level with your own family, or maybe it's something darker.
Well, I don't have much to say about this, other than the fact that I can confirm some of it is due to the, when you come into the office, you're kind of probably taking care of yourself a little bit better on a daily basis. But for me, the domestic odors include Play-Doh, non-toxic paint, which turns into non-toxic edible arrangements for a lot of my kids, and definitely some poo-poo and pee-pee diapers all over the place. So
a little
domestic odor is definitely there.
A little inside baseball about Joe. When the pandemic was coming to an end and people started going back to the office, Joe started doing that George Costanza thing where he'd come out of the bathroom with his shirt off. He had forgotten that, he was interacting with other human beings outside of his family. So that, we had to shake that habit out of him pretty quick.
You still owe me an apology for making fun of my head size when I couldn't fit that sweater that one time. Remember that?
And with that, we must close. And I have to give a special thank you to Haley Keene, who was representing me last week when I was taking some very much needed time off. She did a fabulous job, and I listened to the podcast on the predictions and resolutions. I recommend it highly if you haven't listened to it. Next week, we will be back with our week in review. If you have a question or a comment, send us an email. Subscribe to the podcast with your favorite provider. And if you're in Miami, give us a shout. Thank you for listening and stay well.
All right.